The stock market. Just hearing the words gets people's blood pumping through because of the fact, the excitement that's out there. Right now, at this moment, we have what's called a bull market out there with people sitting under investing money, and the stock goes up and up and up and up and up. Seems like there's no end in sight, but there will be an end in sight because eventually it's going to go down, down, down. Everybody's going to, it's going to happen. And you watch it in the world, in the financial world as it goes through. A lot of it is these IPOs. The IPOs really get a lot of people excited in the process. Here's just something I grabbed this week in the process of this presentation. These are things coming out this week. They publish them typically every Monday and Tuesday as to what's going to be out there and everything else. You can see, let's look at the very first one, Enact Holdings. Okay, the symbol on the stock market is going to be ACT. Okay, it's going to be exchanged on the NASDAQ exchange for over the counter. Okay, the price range they're hoping, not for sure, they're hoping to offer it at $20 to $24 a share, but it's going to be whatever they can market it. In the background, this entire time, the CEO and an entire group of people in the background at ACT, they've been talking to people, they've been getting on the phone nonstop saying, hey, we got a stock offering, an IPO is going to come out, you need to be on the base. They've been selling it nonstop, probably for 10 months to 18 months in the background. It takes a lot of work to be involved in the process. The investment bankers, I got a great investment coming up. Come on over here. This will be great. We're going to issue 22 million plus shares of stock, and this is going to go right through the roof. They don't know where it's going to go, but it's sales pitch in the process. They're going to sell 22 million plus shares of stock. 22 million times 20, that's a lot of money. But that money is going to sit down there and be a giant pot of money, gold, so to speak, for that company to expand all of its operations, and then maybe even its R&D department as it comes through with new products as it goes through. You'll see all of these listed here. But if you go online right now, you'll see that this has changed because of the fact that a new week's expanding and somebody else is out there, somebody else hoping to sit down and strike it rich as a company to sell their stock as an IPO, initial public offering. There's another thing out there you're going to hear about. It's called a SPAC. What in the world is a SPAC? Spackling is what I put on the walls to patch a hole. No, it's not something different. A SPAC, it's a special purpose acquisition company. It really is something, it's been out there for a long time, but it really became popular in 2015. What is a SPAC? There's no commercial operations. It's nothing but a paper organization. They sell stock. And they have, the official name is SPAC, Special Purpose Acquisition Company, but we also call them blank check companies. So somebody sits down, they organize an IPO, they sell shares of stock in this blank check company that has no services, no products. All they're going to do is they have a vision that they're going to sit down and merge with another company and take the capital that's inside of them and join them together and actually dissolve the SPAC's name, okay, and merge it into the other company completely. So that way they can take over an existing operations, the company that has existing operations. They don't have to go through all the sales pitches. They just got to make a couple of phone calls, and the SPAC comes by and says, yo, dude, we want to sit there and invest in the company. Hey, man, that'd be great. I'd love to have you over here. Come on, come on, come on, come on. Okay, so they come in and they merge the companies, and all of a sudden, boom, just like that, the company's got $250 million in its coffers instead of having to go out and hawk it for 10 months or 18 months in the process. And by the way, that could be market timed in the aspect of instead of spending the year and a half trying to sell your IPO, you continue your work and you're not distracted by the process. So a SPAC, you sell stock in a company that does nothing, produces nothing, and all that happens, you sit down and you cut a deal over here and you make a deal in the process, and who's ever in charge of it, they merge the two companies together. So the woman that's driving the entire force, she's the one that in this company over here, she sits down there and she works with her board of directors and this board of directors, they merge, the SPAC disappears because they put all their money into this and they merge and they adopt the name of the company that they've just bought out in the process, and they have a massive fund impetus instantly in the process. It's very interesting in the process. What they're doing is sidestepping the process of the company going through an IPO by having a the company that does nothing, a SPAC, merge with it in the process. Here's a couple things out there. You'll see the change in the names and everything else. The IPO date, they went out, they sold their stock. They went through the trouble of 10 to 18 months of doing an IPO, but the company they take over doesn't have to. A lot of startups are using it. It really helps the aspect of the investor because they put the money in. They don't even know what they're going to become by the time it's done when they first start. So that being said, a big deal breaks and boom, they're already on the ground floor. So a couple of other things you have to know. A SPAC is something new that really became popular recently. But for a long time, in 1934, we created the Securities and Exchange Act, and it created a commission called the Securities and Exchange Commission. It's a federal agency, and they regulate all the various exchanges. You'll see their name mentioned on a regular basis if you watch the stock market or the bond market or any kind of investment market. They're the ones that regulate it to make certain we don't have massive changes that can damage the American economy. Whenever you sit down and you offer stock as an IPO, or you have a people buying your stock, you have to issue what's called a prospectus. It's a version of the financial information of a company that they filed with the SEC. Sometimes they're short. By short, I mean 14 pages long. Sometimes they're 50 and 60 pages long. They have all this micro detail required by the SEC, which you as an investor are entitled to. And sometimes if you actually read it, almost nobody reads these things unless you're going to put a lot of your life savings in it, then maybe the fine print will mean a lot to you. So pay attention to prospectus, especially if you're investing a large amount of money. There's also a critter out there called insider trading. Let's see, if you sit down and you're talking over here and you have a secret knowledge that this company, they just found a great lithium mine site down in South America. As soon as they announce it, the stock is going to go up. So they go out and they buy 100,000 shares of stock, and they're working inside the company. And they sit down, and sure enough, they sit there, they make the announcement, and that person bought the stock at $10 a share. Now it's $100 a share. You are now a criminal. Yes, a good white collar criminal. And when they catch you, you're going to go to jail. Yes. It's called insider trading. A lot of people sit there to get caught. Even Martha Stewart, you hear about her all the time. She's legendary because she dealt with stock, and she also was involved in insider trading. Trading can be so addictive that sometimes you're blind to the things that you're actually doing. There's a lot of foreign stock exchange. You can also buy stock in almost any country that you want to as well. And foreign investors also invest in US securities as well in the process. Technically, when you buy stock, you're supposed to get a stock certificate. To be perfectly honest about it, most people never see a piece of paper or even electronic facsimile of a stock certificate. It just shows up in their portfolio as a number. When a company sits down and they make a profit, and they distribute the profit to the shareholders. And by the way, the shareholders own part of the company. Whenever you sell stock as an IPO, part of it is the matter of your buying part ownership of the company. So if you have 20 million shares of stock and you happen to sit down and be plentifully rich and you bought 1 million shares of stock, you now own 1/20th of the company. You are an owner. So as an owner, you're entitled to the profits unless they sit down and decide to keep those earnings and not distribute them, in which case we call those retained earnings. But when you sit down and you distribute the earnings of the company to the shareholders, the name of that's called a dividend. Okay, so we call it dividend is when they sit down and do that. And of course, we've already talked about the aspect of the different parts of corporations. And an S Corp can only have a maximum of 100 shareholders. So an S Corp is not going to do an IPO in the same sense as trying to raise $20 million through an IPO. An LLC doesn't have any stock, a limited liability corporation. The only kind of corporation we're talking about that's going to be able to participate as an IPO is the C Corp. And the C Corp, as you recall, is subject to double taxation. So when a company earns a profit, it sits down and it pays taxes to the federal government and the state government in the process as well. And then if they distribute the dividends out to you as a shareholder, you have to pay taxes on that as your own income. Double taxation. taxed as a corporation and taxed as an individual. Double taxation in the process. So by the time you're done, if you sit down and measure the percentage of profits that a company sits down there and they go through and they pay, if they're paying somewhere between 21 and 28%, and you as an individual you're paying the US government 50% of the profits of the entire company. That's a hefty amount. A lot of companies retain the earnings and elect not to distribute the dividends like Amazon, and they plow the money back into the company to make the stock price go up. Shareholders like that. They also like getting a dividend check. So it depends what the company wants to do in the process. The advantage of issuing stock is that you never have to repay the stockholders. So, and that's a big thing. But the disadvantage is those stockholders get to have a say, yo, I don't like what I'm seeing over here. I object. But you only have one share of stock. I still have a right to have my vote in the process. Okay, so in the process, you sit down and you sell the stock, and that gives the person that buys it the right to have a voice in the company. I now, of my one share of stock, I now own 1.5 million shares, and you are going to listen to me. As a matter of fact, I decided I'm running for the board of directors, and I'm going to sit down and I'm going to be on that board because I'm going to vote all 1.5 million votes to me to be on the board. All of a sudden now you have to listen to them. If that person has enough to actually get themselves elected to the board of directors, then management needs to pay attention because they now have a major voice in the operations of the company. Disadvantage. You have two major kinds of stock. There's a whole bunch of sub variations on it, but you have common stock. Common stock is those rights that are normally out there. You can have common stock even in the subchapter S corporation, but in the C corp, you also have the common stock. You have a right to elect members of the board because they own part of the company. They can have different options. If new shares of stock come out, you have right of first refusal. You can choose to buy it or not, but at least you have a choice before other people's do. And also, if there's dividends issued, you have a right to it. That's called the common stock, and common stock has voting privileges. Okay, you also, so for IPO, if you have an IPO coming out, okay, they're going to sit down and sell it. You'll have first right to actually buy that in the process as well. Preferred stock, that I am a preferred stockholder. Being a preferred stockholder, I am above all your commoners. That's not what that's about. A preferred stockholder, they don't even have voting rights, except they got some other cool features. Number one, it resembles from the business side, it resembles a lot of like a bond or borrowing money, because the only benefit they really have is they get the preferred dividends. They get to convert the preferred stock into common stock. They also have cumulative dividend rights. So for instance, if the company doesn't pay dividends for 3 years, that's 3. In the 4th year, they decide to pay dividends. They have a cumulative dividend right. They get dividends for year 1, year 2, year 3, and year 4 before the common stock does. That's why we call them preferred. They're preferred because they have a legal right to have access to dividends before anybody else. That's the price they pay for not having a chance to vote. They also have a lot of features often where they convert the stock. No, it's not because they're selling it for car convertibles. No. Okay, it's convertible. They can convert the preferred stock into common stock. Let's say, for instance, they buy preferred stock, and the preferred stock says, for the rights of any IPO, you have the right to buy 10 shares of stock and trade this in for 10 shares of stock. Okay, so they paid $75 for that share of preferred stock. An IPO comes out. The IPO comes out, and man, the stock hits it, and it's $100 a share. Oh no! And you get the right to have 3 of them. So you take your $75 preferred stock, you turn it over, and also you got $300 worth of common stock on the process. You can convert the stock in some type of ratio. It depends what is on the face value of the stock. But also because of the nature of preferred stock, the company often can call it back. So it's a callable stock, is also says, we're calling back all of that. You must surrender this over here for the face value, whatever that could be. So you have that. Here's the things to know in this section. SPAC, common stock or voting stock, preferred stock, and why it's preferred. A prospective is all the different aspects of the financial tools that have been issued by the institution, whatever that may be specific that you bought. A dividend is sharing of the profits with all the shareholders. and the SEC is the Securities and Exchange Commission. Take care.